What are the best ETFs for dividends here in Canada? Hey guys, it's Adrian here, the Canadian in a t-shirt. And these are my favorite Canadian ETFs that I've been investing in for 10 years. They're diversified across the Canadian market and they all pay a generous dividend, so you can sit back and collect that passive income every month or every quarter. I buy these ETFs every month, rain or shine, whether the market is going up or down. First, some ground rules. I'm only going to cover ETFs in Canadian dollars that contain Canadian companies, so no ETFs that track the US market. I already have several videos on that. Links down below. These ETFs are 100% Canadian, so hold them in your TFSA or RRSP to avoid paying any taxes on your profits. Super quick, an ETF is a way to buy dozens or hundreds of stocks all at once. You get built-in diversification rather than going all in on one company. That's the power of an ETF. So rule number 2, I want broad ETFs that contain at least 50 holdings. I'm not a fan of narrow ETFs like XDiv that just contain 20 stocks. At that point, I'd rather just buy those 20 stocks myself and save the annual fee. Rule number 3, I'm not chasing high dividend yields. So no covered calls, no yield max. I don't want a 10% dividend, but then I'd lose value over time. No, I want quality companies with sustainable and increasing dividends. I want to hold these ETFs for life and enjoy both income and long-term capital growth. That's what I'm looking for. If you've been with me for a long time, you'll know that this is a series I update every few years. And if you're new to ETFs or need a refresher, watch my ETF investing playlist for everything you need to know. Links down below. Now let's jump in, starting with one of my all-time favorites, XIC. XIC tracks the TSX Capped Composite Index, and so it contains 218 of the largest Canadian companies on the Toronto Stock Exchange. XIC is not designed to be a dividend ETF. It just tracks the Canadian market, and our economy is dominated by the financial sector, energy, utilities, all of which pay dividends. And so XIC is accidentally a dividend fund with a yield of 2.58%. And this dividend is paid out every 3 months. This yield is a little lower than usual because the share price is currently trading at all-time highs. I'm hoping for a dividend raise soon. XIC has the lowest dividend on this list, but it has a few advantages. It has the lowest management fee and the widest diversification by far. This ETF simply tracks the Canadian market. It's purely passive management. And so they charge rock bottom management fees with an MER of only 0.06%. So if you have $1,000 invested in XIC, it will only cost you 60 cents a year in management fees. That's almost nothing and a fraction of what you would pay for a mutual fund. Remember, with ETFs, you'll never see this management fee taken out. This fee is baked into the share price. So it affects performance. If the fund grows by 10% in a year, but it has a 0.5% fee, as an investor, our net profit will be 9.5%. Now for dividend ETFs, I like to look at it another way. I subtract the fee from the dividend yield. So if our dividend yield is 2.58%, but we pay 0.06% in management fees, our net income is 2.52% per year. Of course, this is just the income half. It doesn't include capital gains. That's where XIC really shines. But first, let's calculate the amount you need to qualify for a DRIP. A DRIP allows you to reinvest your dividend and use it to buy more shares of a company rather than receiving cash. It automates your compounding and gives you true exponential growth. My favorite broker is Questrade. They support DRIPs on any stock or ETF. And now you can also do DRIPs with Wealthsimple. If you'd like to sign up, use my referral link down below to get a $50 sign-up bonus and to help support my channel. So back to XIC, with a yield of 2.58% and a share price of $41, you'll need about $6,400 to qualify for a DRIP. Let's break it down. With $6,400, that 2.58% yield will give you $165 a year in dividends, or $41.28 every quarter. The share price of XIC is only $41, and so your dividend is enough to automatically buy an extra share, and then you'll receive the remaining 28 cents as cash. Check out my DRIPs explained video to go through all the math, how to calculate this DRIP amount for any stock. So that covers the dividend and the MER. We also want to look at the holdings of this ETF. Let's start with the industry breakdown. This ETF contains 218 of the largest Canadian companies, and it's well diversified across all sectors. This is the Canadian economy. It's dominated by financials at 32%, with energy, materials, and industrials between 12 and 16% each. All those sectors pay out great dividends, along with utilities at 3.8%. The outlier is technology, which makes up 10%. That's the only sector that doesn't pay a dividend, but it's important for diversification. At the bottom, we have consumer staples. Those are essential products like food and hygiene. Consumer discretionary are the non-essentials like electronics or fashion. Looking at the individual holdings, these are the largest Canadian companies weighted by market cap. Here we have the 7 biggest players: RBC at 6.6%, Shopify at 5%, TD 4.3%, and then Enbridge, Brookfield, Canadian Pacific Railway, and BMO around 3% each. You'll notice it's spread out pretty evenly. It isn't dominated by 1 or 2 stocks. That's a good thing. There are 218 total holdings, so pretty much any big Canadian company you can think of, it's there. This was the very first ETF I ever bought, and I've stuck with it ever since. But if you'd rather have a BMO ETF, go with ZCN, or a Vanguard one, try VCN. They're all basically the same thing. They just track the largest Canadian companies. You can't go wrong with any of them. Looking at the share price of XIC over the past 3 months, we see a huge drop in early April when Trump announced his tariffs. But in a matter of weeks, it has fully recovered and back to all-time highs. Zooming out to 5 years, we see a clear upward trend. That's exactly what I want. Long-term capital growth, all while paying a solid dividend. That's why it's so important to invest in secure, quality Canadian companies. Those are the ones I want to hold on to for decades, and this ETF does just that. This is important. Whenever I mention dividend yields, I'm talking about the trailing 12 months, or TTM yield. So for XIC, it has a TTM yield of 2.58%. That means if you add up all of its dividends over the past 12 months, divided by the current share price, you get 2.58%. The alternative is to use the forward yield, where you assume that the current month's dividend will continue for the rest of the year. But that's a false assumption. Many ETFs don't pay consistent dividends. The dividends can change month to month, so this forward yield will swing up and down. In the case of XIC, its dividend just increased last month, so its forward yield is higher than the TTM yield, about 2.66%, but I don't rely on this number. To be safe, I recommend using the TTM yield. It's a more reliable expectation, averaging out the whole year rather than just the high point. Next up, we have the Vanguard ETF VDY. VDY is basically a subset of XIC, focusing only on the companies that pay a high dividend. XIC contained the 218 largest companies in Canada, but VDY contains only 61 of these companies who pay out a high dividend, usually over 3%. So you won't see any tech companies like Shopify, but VDY will offer a significantly higher dividend at 4.2%. And this dividend is paid out every month, so you'll get monthly passive income. VDY is an ETF whose dividend will fluctuate month to month, so we are using the TTM yield of 4.2%. And the same story, this yield is lower than usual because the fund is trading at all-time highs. This is a more specialized ETF. It takes a bit more work to filter out the dividend stocks. And remember, these dividends can change anytime. Because of this extra work, VDY charges a higher management fee with an MER of 0.22%. That's definitely higher, but it's still 10 times cheaper than the average mutual fund. There's no excuse to be paying 2 to 3% a year in mutual fund fees. If you own $1,000 in VDY, you'll pay $2.20 a year in fees. Again, this fee is built into the share price, but I like to take it out of our dividend income. VDY pays a dividend yield of 4.2%, minus an MER of 0.22%, we get an annual net income of 3.98%, plus capital growth as well. Since this dividend is paid monthly, we'll be getting smaller dividend payments, but more frequently. This makes it harder to qualify for a DRIP. We'll need about $14,300. With a yield of 4.2%, we'll get $600 a year in dividends or $50 a month. That's enough to buy yourself a free share every month. That's 12 shares every year. I know $14,000 is a lot of money, but remember, you don't need to reach this DRIP all at once. I haven't gone there yet. Invest what you can and slowly build up to this over the course of years. In the meantime, you'll be earning great passive income and capital gains. Looking at the industry breakdown, VDY is massively focused on the financial sector, with 53% of the fund invested in banks and insurance companies. Energy companies like oil and gas make up 28%, and the remainder is spread between utilities, telecoms, and materials, all of which are dividend heavy. This fund is far less diversified than XIC, and even though the Canadian banks are some of the strongest in the world, having too much of your money tied up in one industry can be risky, so don't rely entirely on VDY. Make sure you also own the other ETFs on this list to get broader diversification. Looking at the top holdings, they're similar to XIC, except they took away low dividends like Shopify and instead went heavier on banks and energy companies. More than half the entire fund are financials, and no surprise, Royal Bank and TD alone make up 14% and 10%. That's huge and very heavy weighting on just a handful of stocks. In fact, the top 6 holdings make up almost half of the entire fund. This ETF is very concentrated and much less diversified, so keep that in mind. Looking at the price chart of VDY, same story. We saw a big drop in April with the tariffs, but a very quick recovery and back to all-time highs. Zooming out to 5 years, there's definitely some up and down, but overall we see long-term growth. And even with the volatility, we still collect those fantastic dividends every single month. At number 3, we have XEI from BlackRock. XEI is similar to VDY in that it is a subset of the XIC Holdings. XEI contains 74 of the largest Canadian companies which pay out a high dividend. XEI contains 13 more stocks than VDY, so a bit more diversified. And it pays a higher dividend right now with a yield of 5.4%, and this dividend is paid out monthly. Same story as VDY. This ETF requires more work to manage, and it has an identical MER of 0.22%. So if you own $1,000 in XEI, you'll be paying $2.20 a year in fees. With a dividend of 5.4% and an MER of 0.22%, that gives us a net income of 5.18% collected monthly. Since XEI has such a low share price, $27.90, it makes it much easier to qualify for a DRIP. You'll need to invest $6,200 with a yield of 5.4%. That gives us $335 a year in dividends or $27.90 a month. That's enough to buy an extra share of XEI every single month or 12 shares per year. If you've seen my members only videos, you know that I especially love XEI because of its low share price. Whenever I have leftover cash, $30 or so, I buy myself an extra share of XEI. That's why I love using Questrade or Wealthsimple. I don't pay any commission fees. So even for small purchases, none of my money goes to waste. If you'd like to see my entire portfolio beyond these ETFs, hit the join button down below to access my exclusive portfolio reveals and the breakdown of the stocks I'm buying every month across my TFSA, RRSP, and FHSA. This membership program costs $5 a month, so if you want to support my channel, I do appreciate it. If you'd rather stick to my free videos, all I ask for is a thumbs up and share it with a friend. You can also follow my trades and track my portfolio for free with the Blossom Investing app. It's an amazing community of 300,000 investors, and you can follow my friends like Brandon Beavis, Joy Yang, and BD Investing. Use my link down below to download the app on your phone. Back to XEI, the biggest difference between them and VDY are their holdings. Remember, VDY was heavily concentrated on the financial sector, over 50%. XEI is spread more evenly, with 31% in financials and 29% in energy. By stepping away from the financial industry, XEI gains more exposure in telecoms, utilities, and even real estate. So I'd say it's more representative of the overall Canadian market. Looking at the top 10 holdings, again, XEI is spread more evenly. In fact, all of the top 10 holdings are at about 5% in weight. Compare this to VDY, where RBC and TD were over 10% each. XEI is less dominated by one or two big players, so it's more like XIC in that sense. Looking at the stock chart, we see the same story. Massive drop in April, but a quick recovery. We're not back to all-time highs just yet, but very close. The peak is still early 2022, right before interest rates started shooting up. I expect to reach new peaks this year, and in the meantime, I'm collecting those fantastic dividends every single month. So those are my 3 favorite dividend ETFs in Canada. XIC has the lowest yield, but the widest exposure. VDY has a higher yield and pays monthly income, but it's heavily concentrated in the financial sector. XEI also has a high yield, paid monthly, and it's more evenly weighted between the energy and financial sector. Personally, I own all three of these ETFs, and yes, there is overlap between them. It's important to diversify and gain exposure of the entire Canadian market, rather than trying to pick the best one. To actually buy these ETFs, I recommend Questrade. They're my favorite brokerage in Canada. You can buy all these ETFs totally for free. No commission fees. Use my referral link down below to get a $50 sign-up bonus. I also like Wealthsimple and Moomoo. All great options. Links down below as well. So thanks everyone, and I'll see you guys on the next episode of the Canadian in a T-shirt. Bye guys.